Welcome to Financial Literacy for Educators. I cannot wait for this one with the amazing Tamara. Okay, so to get us started, let's go through some announcements first. Who are you, crazy lady? I'm Dr. Desiree Alexander. I'm the founder, CEO of Educator, Alexander Consulting, and your host for today. These are all of the ways that you can contact me if you are watching us on the YouTube channel. Hello. No, you do not get a certificate, but you do get the knowledge. Right underneath this video in the description, you will find the resource for today. What are some webinars that we have coming up? I didn't think you would ask. In August, we have Back to School with Bunsey. Yay! Then in August, this is brand new. I haven't even announced this on Twitter or anything yet. So get in on it before I even announce it. I'm back. So are my students. Now what? We know that we're all going back to school, and some of us have been teaching virtually for a whole year. How do we get that and bring it into our classrooms? That's going to be a really good one, guys. Then we have in September, Joy is coming back. Google, you and your classroom. What are those 2021 Google updates? I don't know. I can't keep up with all that stuff. That's okay, because Joy does it for us. Then we have September 11th. Equity is not an add-on. What? Preach. So we're going to be talking about equity with an amazing panel. I know one of those people. No, I know all of those people. They're all awesome. And then we're going to be talking about, in October, infusing digital reading and writing tools in blended remote or face-to-face classroom with Dr. Hines. We're going to keep that going October 9th, creating engaging and interactive lessons with the one and only Nearpod. And someone asked, can we do a Nearpod session? You got it. Then someone asked, can we do a Seesaw session? You got it. Using Seesaw for dish, sit, and reflections. And this is one of my good friends. Yay. Can't wait for her to come and finally be a guest on the EA webinar series. And then I am going to be at TCCA in Houston, Texas. Hopefully live. Who knows what we'll be by October, but we're all going to cross our fingers. So hopefully live at TCCA, completely free, one of my favorite conferences. And then in December, we have a whole panel talking about Google Educator certifications. This is going to be a crazy time. I should have did 2 hours instead of an hour, but you know what? That's what we're going to have. So we're going to pack in a bunch of information about getting Google certified as a trainer, innovator, and our coach. You might have said, Desiree, you went so fast through those. I couldn't write them down. Guess what? They're all on my website under upcoming events. So as long as you heard about it and it piqued your interest, go to that site and look it up and register. But guess what? It's time to get started, y'all. I know I got a chill. Did you feel the chill? It's time to get started with financial literacy for educators.
All right. Thank you so very much for that energetic introduction, Desiree. You absolutely are like the most energetic person that I watch on YouTube, on Twitter, everywhere. So thank you so very much for that introduction. And before I even get started, I want to offer a huge shout out and a huge thank you to Dr. Desiree Alexander for providing this platform for people like me to present content, as well as for participants to take in professional development that they want to see on their terms and all at no cost. So thank you so very much for sharing your passion for education and for learning for people like me and for people like our participants who are logged in right now. And with that, I say welcome to all of you. My name is Tamara Mitchell, and I am an educational consultant, as well as currently employed right now as a school business official, as an assistant superintendent for business and financial services. That is my official job title. Thank you so much to those who are joining us live on this lovely Saturday morning, and a big welcome to those of you who are watching the recording on YouTube. So today we will be talking about financial literacy for educators and the importance of it. So why the focus on educators, you might ask? Well, as I mentioned, I myself am an educator. And I'll share an interesting statistic with you that I came across that really piqued my interest and my drive for wanting to share information with educators in particular about financial literacy. So the Bellwether Education Partners in 2019 did a study, and that study estimates that a whopping 81% of teachers who started working at age 25 will not qualify for adequate retirement benefits under typical pension plans. That statistic was totally shocking to me, totally blew my mind when I first saw it. And again, it's a big driver as to why I have a desire to help people, educators in particular, put themselves in a better financial situation. So when it comes time to ride off into the sunset and do that alarm clockless retirement, that maybe the financial picture will look a little bit better, and people will be more comfortable and able to enjoy that retirement. So as I move through the webinar, oftentimes financial conversations tend to have a lot of jargon. I will not do that. If I mention a term, I will provide a brief definition of it so that everyone is familiar with what I'm saying. And with that, let's go ahead and get started. Oops. So the most important thing for me to say today during this webinar, big disclaimer, I am not a licensed financial advisor. I am not a certified financial coach. Information that I will be sharing with you today is based on my personal experiences, research that I've done that's available to anyone. There's a lot of good information available online on the internet, or a combination of both. So my hope for this webinar is that you will have at least one takeaway, hopefully more than that, but at least one takeaway to be able to implement for yourselves that will positively impact your financial stability and your personal wealth moving forward. And I will refer back to the fact that I am indeed not a licensed financial advisor, not a certified financial coach as I'm going through this webinar, because I don't ever want to represent myself as such. I'm just a person who is knowledgeable about finances, personal experiences, school of hard knocks, all that, and what I do in my day-to-day that I've been doing for a while now as a school business official. So a little bit about me. I have a bachelor's degree in accountancy, also have an MSED in school business management. I am a licensed school administrator in my home state of Illinois, and I have been in the most wonderful field on the planet, education, for about 22 years now. 15 of those years serving as a school business official. So before I got into the role of school business official, I was working in the school business offices, so had exposure to the role and to things, all things financial in a school business office, but officially a school business official for 15 years now. Again, my current job title is Assistant Superintendent for Business and Financial Services. As I mentioned in the intro, that statistic regarding financial stabilities of educators in retirement is a driving factor for why I enjoy sharing this type of information. In my years as a school business official, I've seen it all. I've seen the brand new teachers coming in, and it may be the first time they're either seeing a paycheck, period, or their first time seeing a paycheck that isn't for like a more minimum wage or a service type job. And then I see seasoned educators come in who know all the right questions to ask because they have been in this for a while, and they understand the questions to ask to fully maximize their employment, as well as set themselves on a course for planning for retirement. And before I go any further, for those of you who hear me say the word retirement and you are thinking, that's a long ways off. That was me too. 20 years ago, I felt that way. And let me tell you, I wish I had taken planning to heart back then, because if I had taken some of those things to heart back then and put some things in place 20 years ago, I would be in a much different financial situation now. It is never, ever, ever too late to start down that road of financial literacy, improving your financial position, learning about retirement and all of that. It's never too late to learn, but I encourage people always, the sooner you start learning and the sooner you start planning, the better, because it really is about the time value of money. So again, just sharing some things based on my experiences. So hopefully people will avoid the pitfalls that I had. So what will we be talking about today? In a nutshell, this is going to be a very high-level discussion on financial literacy. There will be some things discussed in here that are familiar to you. There may be some things that aren't that familiar to you, and hopefully this webinar will give you a good place to start, at least to begin asking yourself questions, to drive some research on your own, to have some questions asked to a licensed financial planner if you choose to go that route, or do things on your own as far as improving your financial position. It's, again, my passion. Financial literacy is one of my passions. My elementary and high school education did not touch on this topic at all, and not a knock to my parents at all, but it really wasn't a big topic of discussion at home either. So this is all pretty much self-taught and things that I have learned both in college and through college courses, and then just doing research on my own. So table of contents today. First, I will briefly touch on what financial literacy is and why it's important. Then move along to a discussion on salary and benefits, which includes a quick scenario to help you determine which of two job offers is best, because oftentimes we are considering changing jobs, changing districts. Sometimes that job offer with a higher salary may not truly be the best job offer. So we'll just do a quick scenario for with some tips and tricks in there to figure out if the higher salary is actually going to net more money in your pocket if you go with that versus a lower paying job. Then we will move on and talk a bit about credit and financial wellness, and finally wrap up the conversation with some retirement planning. So let's get into it. Financial literacy. What's the definition of it? So according to the National Financial Educators Council, which I am not a member of, but this definition is available out there on the internet, financial literacy is possessing the skills and knowledge on financial matters to confidently take effective action that best fulfills an individual's personal, family, and global community goals. Long definition, lots of words. What does that all mean? For me, I break that definition down as financial literacy is knowing what you need to know to take the best action to meet your financial goals. The knowing what you may need, or the knowing what you need to know, may sound strange, but think about that phrase, you don't know what you don't know. So you may not know the questions to ask to get the results that you need. So basically you need to be as informed as possible about all things financial so that your choices and actions result in the best possible outcome. In my opinion, financial literacy is understanding, at least to some degree, all of the things represented in these clouds that you see here, and then some. So we've got salary and benefits, credit score, wealth building, debt, retirement planning, banking, investing, interest rates, budgeting, all of those things, and then some. And we won't touch on all of those today as we move through this webinar, but we will be touching on some. I think some of the foundational things that everyone should know and everyone should be moving towards to increase their financial literacy, to improve their financial position, as well as hopefully build again towards some personal wealth. Going back to that statistic always comes to mind, that so many teachers, 81%, will not be in a position to retire comfortably with a traditional pension without doing something on their own to help supplement that. And why is financial literacy important? So this is just a short video clip that to me just sums it up all up. Why is financial literacy important? So let's take a look. Okay, so as that old saying goes, money makes the world go around. We've heard it all our lives probably, and it really is the truth. Let's face it, it's not just our local and national communities, but our global community, all driven by money. So the better the understanding is you have about money and finances, the better your chances are at winning in the money game. Financially literate people are knowledgeable about financial vehicles, whether we're talking about traditional bank and credit accounts or credit union accounts, stocks, mutual funds, etc. Does that mean that in order to be financially literate, you have to be an expert and know all there is to know about all of those things? Absolutely not. It really starts with educating yourself beyond what you know and then building from there. So if your knowledge is at the beginner level, just take from that and build on it, and that will definitely improve your financial literacy. So financially literate people, again, they're knowledgeable about financial vehicles. They also tend to set budgets and stick to them. You have to know where your money is coming from and where your money is going for any of this to work as far as getting a hold of your finances and improving your financial position. To that end, there is a budgeting tool included in the resources and tools listing for all participants. That tool will help you not only compare your budget to actual performance month to month, but it also includes a graph so that you can see on a percentage basis what portion of your expenses go to which category. So if you're spending too much on Starbucks, then you know that maybe you need to cut back on some of that Starbucks spending and put more towards saving, whether it's saving for retirement, saving for your emergency fund, or saving for a vacation that you want to take, what have you. That tool will help you uh, get on that path towards setting up a budget and sticking to that budget, which is very important. I say that not because it's what I do for a living, but because it's how I live my life. Did I always live my life according to budgeting personally? No, I did not. Even though that's what I do for a living and what I have done for a living, I wasn't diligent with it myself. So lessons learned that I am sharing with others to try to help them avoid those pitfalls. Because financially literate people know where their money is going, they also tend to more confidently manage that money and correspondingly make more sound financial decisions. Financially literate people tend to understand responsible use of debt. I was one of those people, just a confession, many, many years ago when I was younger. I was one of those people afflicted with the just charge it syndrome. Available credit did not exist very long on my credit cards when I was younger. That's just the fact. If I had a credit limit of $1,000 and there was $200 available, I was going to find something to spend that $200 on, maybe make a $50 payment, which that's not really making a dent in anything. And then as soon as there was available credit, that credit card would be maxed out again. Got myself into some financial trouble many years ago, which is why I take the position now that I do on responsible use of debt. It is a process for sure. No knock against anyone who is moving through that challenge right now as well, or that may be just in it and not necessarily taking steps to get out of it. No knock at all. We all have to go our own path and find our own way, but that's just my personal experience. So I have moved past that stage, but I can definitely relate to those who are there or who have moved through it as well. Also, financially literate people tend to make decisions that are driven by long-term goals versus short-term gratification. So that goes back to the previous bullet. Being driven by short-term gratification leads to less responsible use of debt, which is something that more financially literate people tend to avoid when possible. So let's start the conversation with your salary and benefits, understanding your paycheck and the value of those benefits, okay? The first step towards financial literacy is understanding that salary and benefits package. Budgeting is very important, but if you don't understand your salary and benefits, then it's not really going to do any good. And both are important because your benefits have a monetary value. There are some jobs, depending on the salary, there are some jobs where the benefits package is actually worth more than the salary. I've seen that in my years as an educator, where especially with some of our paraprofessionals are working for the benefits package. The pay is not all that great, unfortunately, but the benefits package is very rich. And so that is, aside from liking the work that they do and working with students, that is why they do what they do. So short conversation or brief conversation. It might sound elementary to some, but please bear with me for a moment. And hopefully there'll be something here as a takeaway for everyone. So understanding your paycheck, when you get your paycheck, first time you get your paycheck and every time you get your paycheck, whether it's the start of the school year or the middle of the school year or what have you, please look at that paycheck every time. I myself have been guilty of not looking at my paycheck every time I get paid. But it's very important that you look at that check. A lot of people just look at the direct deposit hitting their bank account and they figure, oh, it's good. It's the same dollar amount as last time. Or maybe it's a little bit higher because you did some extra duty or something. But only caution, word of advice I will give you about that paycheck, please just look at it every time. And then if you're a teacher, be sure to understand the salary schedule. And for administrators, be sure you understand your contract. So what I mean by that is be sure to understand wage increases if they happen at all and the timing of them. We do have faith and trust in our business departments. I'm an assistant superintendent for business. I trust my team, but I always tell people, check the math. Double check your payroll department. It is perfectly fine to do that. There is a free paycheck calculator tool available to participants as well, included on the resources and tools sheet. There are various tools out there that you can find on the internet to calculate your paycheck, to all kinds of financial tools that are out there. But I would definitely encourage you to use one of those tools to confirm that your paycheck is correct, especially when you are changing years and there is a step change, a lane change. For administrators, you've gotten an increase or what have you. So just do that to confirm your pay. As for extra duty pay, if you qualify for that extra duty pay, some questions you want to ask and understand how that pay will show up on your paycheck. For instance, if you are the volleyball coach, will that pay be spread evenly over X number of pays? Or will you get the entire stipend in one lump sum at the end of the season? Will you get half up front at the start of the season and the other half later? And then speaking of the number of pays for teachers, especially, or for even administrators who work less than 12 months, be sure to ask the question and understand how your pay is dispersed. If you are working less than 12 months, will you get paid over 12 months, or is that pay going to be over 9 or 10 months? Some people enjoy the condensed payment schedule because they get larger paychecks. They understand that they won't get a check in the summer, so to speak, but those checks are larger during the year, and they might supplement their income over the summer with other part-time jobs, so they're able to manage that. So just be sure to ask those questions. Also, so moving on to FICA, if applicable. So deductions on your paycheck for Social Security and or Medicare. Understand if you are working in a state that requires you to contribute to Social Security. I work in a state that does not. In Illinois, there are 12 states that do not have teachers pay into Social Security. And then the rest of them, there are 12 that don't, 3 that have kind of like a hybrid thing going, and then the other ones, teachers pay into Social Security. So be sure you understand that, especially if you are looking to take a job in a different state, you'll want to know how that state operates. So for me, working in Illinois, I don't pay into Social Security. But if I hopped over to Indiana for a job, I would begin paying into Social Security. So you just need to understand how all of that works. Your state pension system. Be sure to familiarize yourself with your state pension system. Another confession, that is something I did not do early on in my career. I did not really familiarize myself with the pension system. So the earlier you do that, the better. So you want to ask the questions. How many years do you have to work to become vested? Which vested in a pension system means before you're able to draw that pension, okay? What is the minimum age to begin drawing said pension after you're vested? What are penalties or reductions in pension if you draw your pension sooner than the full years of service or sooner than the full retirement age? It's usually a combination of years of service and age that will equal a full pension. So you'll want to have an understanding of that. And then understand if there are tiers within that pension system as well. For instance, in the state of Illinois, I am a member of the teachers retirement system. There is a hard line. 2011 is the cutoff. So we have tier 1, 2011. If you were employed before January 1st, 2011, you're tier 1. If your first date of employment in the system is after January 1st, 2011, you are tier 2. Those benefits are vastly different between the two tiers. So you'll want to understand the difference if said difference is set up in your home state as well. Benefits deductions. You will want to ask questions before you accept a job regarding health insurance. Very important question to ask is, what is my contribution for health insurance? That varies widely from district to district. You have some districts where the Board of Education will pick up 100% of the benefits cost. You have other districts where the Board of Education may only pick up 75% of the benefits cost. And that is going to make a big difference in how your paycheck will look. So you definitely want to ask those questions. Other deductions are highly individualized, so keep an eye on that. So your federal and state income tax is going to be individual based on the exemptions you have, any tax shelters that you have set up or what have you, wage garnishments, judgments, child support, alimony. The one thing that I will say about any wage garnishments is to be sure you are aware of when those garnishments will expire and that you're keeping an eye on your paycheck as well, because you don't want to have the business office withholding money from your paycheck for a debt that has already been paid in full. So just a tip there. Let's talk a little bit about the language of medical benefits. This is one of the most confusing topics for a lot of people. It's something that I did not understand for sure when I first started my career. So we'll just go over some of the language and how it will impact your pay. Okay. And if you're someone who's relatively healthy and you only use your insurance for those routine annual visits that are already covered, this may not mean much to you, but it will when you need to utilize those benefits. And trust me, the day will come when, even if you are one of those people that never used your insurance before, the day will come as we age where you will definitely need to use them. So understanding the language is key. So deductible. Your deductible is the amount you pay before insurance will pay 1 cent. Okay. This does not apply to visits or exams that are automatically covered at no cost to you. So your insurance is automatically going to cover your annual wellness exam and things like that. So this doesn't apply to that. Your deductible would apply, say, if you weren't feeling well and you went in for an office visit, then you would pay a deductible towards that. Deductibles reset annually based on your plan year. A lot of plan years reset on January 1st. And so just be sure that you check in with your benefits coordinator to see when your plan years reset, because you could be good in 1 year and you've met your deductible and you're rolling forward. And then come January 1st or whatever, you go to the doctor and then you end up with a bill for a couple $100s. So you just want to keep track of that. Copays are the cost to visit your doctor. Those may or may not be included on your health plan. It just depends. Again, these plans are very different. Depends on your individual health plan and what's available to you at your school district. Copays, again, cost to visit your doctor. Also, copays apply to prescriptions. So depending on your health plan, there's usually several tiers of copays related to prescriptions. So be sure to familiarize yourself with that. Coinsurance is the percent of the cost that you pay after meeting your annual deductible. So for instance, your plan may pay 80% of the cost of an office visit, leaving you to pay the remaining 20%. So that would be your coinsurance. So then if an office visit is $100, your coinsurance piece of your responsibility is 20%, you would have to pay $20 for that visit, including any copays that might be on your plan as well. Out-of-pocket maximum is an annual dollar amount that's based on your deductible and coinsurance in most cases. There are some rare plans out there where copays count towards the out-of-pocket maximum, but again, those plans are rare. So it's a question that you can ask if you're looking for a new job and talking about the benefits. Your out-of-pocket costs, again, will be the maximum contribution that you would pay before insurance will cover everything at 100%. And that would be eligible and approved costs. Your portion of premiums do not count towards out-of-pocket maximum. So just keep that in mind. if you have to pay towards your premium, that won't count towards your out-of-pocket maximum. And again, very important to know all these things when you're considering a job offer. Even if you've been in your job for a few years and you really don't have an understanding of your benefits, check in with your benefits coordinator, just so you know exactly what you have, just how good or not your benefits package is, because you know that then as you're applying for jobs. And you can even check in if there's a job you're interested in applying for. You can even reach out to a benefits coordinator and ask those questions before you even apply for the job, just in case it's going to be a benefits package that is not going to be feasible for you. Okay, so this is a scenario that I told you about. So we have two job opportunities here. So let's compare the salaries and benefits to see which one would net in the most take-home pay. Just on the surface, you see a salary of number one, 50,000, number two, 55,000. So just if we weren't considering benefits and how that would impact, the obvious choice would be to say, oh, let me go with job opportunity number two because I'm going to make 5,000 extra dollars in all of that. So, but let's take a look at this. So for job opportunity number one, with that salary of $50,000, what we want to do is automatically reduce that by the $500 per year insurance premium. Okay, so now we're down to 49.5. And let me say that as we're doing, this is just a simple basic example. No tax implications taken into account here. So not taking into account whether those benefits are pre-tax, how much other pre-tax stuff you have set up, just straight math. Okay. So 500, the 50,000 minus the $500 is where we're going to start. Okay. And then let's go back to the example now. So we're looking at the co-insurance of 90%. So that means that if you go to the doctor, you would have to pay 10% of that cost. You have a deductible of $300 and then you're out of pocket max at $1,800. Job opportunity number two, $55,000 salary, deduct your insurance premiums of $3,500. Okay. And so now we need to reduce that 55,000 down to 51.5. So now that number is not looking so great. Look at the deductible there of $1,000, co-insurance of 80%, and then the out-of-pocket max of $4,000. So keeping all of this in mind, which one would be the best financially? Again, it's not always clear. So you really have to do the math on all of this stuff. So in this example in particular, it works out to be that job opportunity number one is the better option. The difference between the two is only $200, but number one is actually works out to be $200 more than job opportunity number two. So without doing this quick, simple exercise, you could end up taking a job based on seeing that higher dollar amount and thinking that you're putting yourself in a better financial position, and you're really not. So just keep that in mind. And a lot of times districts will pay higher salaries because their benefits packages aren't that rich when compared to a lower salary district, even in the same town. You'll see districts in the state, especially if you live in a state that has smaller school districts, like in Illinois, we have over 850 school districts. It's a lot. In the same town, there will be districts that might be separated on the salary schedule by like $10,000 in the bachelor step zero when you compare that. A lot of times it's because the benefits packages are so different. That lower paying district will have a really rich benefits package, and the higher paying one, they kind of try to offset it because they know their benefits aren't that great. Okay, so let's talk about credit and financial wellness. As I mentioned, financially literate people tend to use debt in a more responsible way. And I also shared how I had to learn some lessons from the School of Hard Knocks myself as it relates to credit card debt and managing credit and kind of making sure my credit score stayed as high as possible. So we'll talk briefly about some strategies that I used to reduce and ultimately eliminate debt, which in turn raised my credit score. And hopefully there'll be something here that you can take away from this as well. So why your credit score matters. We all hear about a credit score all the time, and our credit scores matter in a lot of things, oftentimes things that we are not aware of and that we may not even consider. There are even some jobs out there where your credit score matters. So keeping it as high as possible is very important. So how does our credit score impact us? Higher credit scores equal lower interest rates to borrow money. Your score is going to impact the rate that you're offered on home and auto loans. And that can be huge, and credit cards as well. That can be huge. For mortgages, especially, this can equate to tens of thousands of dollars over the life of a loan if you are obtaining that mortgage with a lower credit score, if you were compared to someone that had a higher credit score. So that can add up. So it's best to put yourself in a position as best as you can to have your credit score as high as possible, to definitely keep more money in your pocket when it comes to stuff like that. Those percentage points may seem like it's not that big of a deal. Oh, it's only 0.5 of a percentage point, but it does add up over time. Trust me. So the more you can do to keep that credit score high, the better that you'll be. Also, higher credit scores are going to get you access to higher quality lines of credit. So for instance, if you have a credit score that is below 700, you may have access to credit cards that don't offer a ton of benefits. But if your score is over 750, you may have access to credit cards that have a ton of benefits. And I will say that I am not advocating at all for anyone to go out and get credit cards and rack up a bunch of debt on credit cards at all. Not advocating for that. If that's the position you're in, no judgment here either. Just saying that it's something to consider. The thing about credit cards and benefits available to you is the higher your credit score, the better those benefits are going to be offered. And you're able to take advantage of those benefits most often if you are not having revolving debt on those cards. So you're not carrying your balances every month is what I mean. If you're a type of person who gets to the point where your credit cards are paid off every month, then you're going to see some benefits coming from having access to some of those higher quality credit cards. Okay, again, not encouraging anyone to go out and open up credit cards and get into debt that may be hard to pay off. But if you're in a position where your credit score is reasonably high and you can responsibly use those cards and take advantage of rewards cards even, you're going to be in a better position with a higher score versus a lower score. And then again, better home and auto insurance rates. A lot of times people don't take into account that your credit can impact that, but it can. Ways to increase your credit score. I've been through this process myself, so this is another lesson from like personal experience, how to increase your credit score. One of the things that you should do, review your credit report often. Everyone can get free access to a credit report once per year from the credit bureaus. You can also, if you sign up for a credit monitoring service, you will also have access to frequently run your credit report. You running your credit report does not lower your score in any way. If you have your credit report being run to try to get lines of credit, credit cards, loans, auto loans, mortgages, things of that nature, that's going to hit your credit score and lower it. But you checking your credit yourself does not lower your score. So be sure you are doing that often. As you look at your credit report, you want to verify the accuracy of the accounts there. Also identify accounts that should reflect as closed. So if you had an old collection account out there and you paid it off, but it's still showing up on your credit report as open, you want to reach out to the credit bureaus and get that taken away. Also, clear any negative history if at all possible. So maybe there was a creditor reported that you made late payments for a period of time and you know for a fact that you didn't. That's the kind of stuff that I'm talking about, clearing the negative history if you can clear it. There are some services out there that will tell you that they can legally clear negative things from your credit report. I'm not sure about those. I will say that I'm not sure about those. If you come across one of those services, I would say do your research and then do some more research before you engage with any of those companies to be sure that what they are telling you is true and that it is legal and that it's not going to end up costing you more money in the long run, because now you have paid them to provide a service to you that is not going to work. And now you may still have these debts hanging out there that you need to clear up. Another way to increase your credit score is obviously pay down that debt if you can. As part of that, utilize 25% or less of available credit on your credit cards. The best way to operate with a credit card is to have $0 utilized, 0% utilized. That's not always possible for people. So if you have to use those credit cards, if at all possible, try to keep that utilization at 25% or below. And what I mean by credit utilization is the percentage of the available credit. So if your credit or percentage of the credit line, if your credit limit is $1,000, 25% of that, $250. Okay, so try to not charge more than that 25%. Be sure to make your payments on time. Kind of advanced when you get to a point of being out of debt or closer to being out of debt, pay those credit cards in full each month. And I'll tell you a quick story about a hack that a coworker taught me. It was shocking. I had no idea that this was the case, but I can promise you that it's true. So what she told me, I had gotten to the point where I was paying credit cards off in full every month. I thought I was doing it the best thing, and that was the best thing I could do for my credit score. Credit score wasn't moving. Coworker told me, okay, no, what you need to do is get that statement to a zero balance every month. So when the statement closes, it should say that you owe $0. If you're just paying your credit cards in full every month, you could pay the previous statement activity, but still have what you just charged recently open. So you might make a $200 payment, and now there's still $200 hanging out there. So what she said was, no, pay that $200 off, get it to zero. So now your statement balances are zero. I did that, lo and behold, my credit score jumped 10 points. Okay. I was not diligent with it for a couple of months. Some stuff was going on. Credit score went down. Once I got back to ensuring that that statement balance was zero, the credit score went back up. So that is a more advanced hack. Again, you have to get to that point to where your cards are paid in full and you are financially able to comfortably do that. But if you get to that point, that is a way to start making that credit score move and go up even higher. Because mine was stalled out. It moved when I started doing that. There's a lot of information on this slide. Some of it applies universally to each of these categories as far as building, rebuilding, and protecting your credit. So I will not spend time reading through everything here, but I just will touch on a few important items that are covered here. Again, credit utilization is important, just as important as on-time payments. So you'll want to be sure you are not, if at all possible, you are not utilizing more than 25% of your credit limit on your credit cards. Also, if you're in a situation where you are building or rebuilding credit, use secured credit cards only if absolutely necessary. The reason I say this is these cards tend to have high fees. They may have very high interest rates or have high annual fees, and they also are known to have lower credit limits. So that's going to impact you with that credit utilization. So if you have to do it to rebuild your credit, by all means do so, but just only do so if absolutely necessary. And again, if you're in a situation where you need to utilize credit repair services, please fully vet anyone before you work with them. Very important, because you don't want to spend your money on a service that is not necessarily going to work for you. As for protecting your credit, sign up for credit monitoring, review your credit report. And the last thing I will mention about protecting your credit is if you absolutely can't resist the urge to co-sign for a loan for someone, please be sure to do so for someone that you know will be able to pay that loan back. I tend to not do it because that money is the fastest way to ruin a relationship for me. Like I can't. So, but if you're in a situation where you need to help a family member out, and you absolutely trust them and you know that they're going to pay that loan back, okay. But again, just be very careful and cautious as you're protecting your credit with that. Debt reduction tips. Again, a lot of information here on this slide. Balance transfers. You'll want to be sure to review balance transfer fees and expiration terms if you're going to transfer that high interest debt to a lower interest credit card. And also, as far as the terms, be sure you check them out like all the way. If it's a 0% interest promotion, for instance, I will give another confession of where I screwed up one time. So 0% interest for 12 months. I didn't understand that if the balance was not 100% paid in full at the end of that 12 months, the interest would be charged to me at the end of that period on the entire balance. So for instance, if you balance transfer $2,000, so you take $2,000 from a high interest credit card to a 0% interest promotion, and you pay off $1,900 of it, but that term expires. On your next statement, you'll see that $100 that's still hanging out there because you didn't pay it off, but you will also see interest charges on the entire $2,000 balance. So needless to say, I was highly upset when I made that mistake, and I've never, ever, ever made that mistake again. Okay. One hack, or as far as debt snowball, we've all heard of the debt snowball. So you choose the account with the lowest balance, attack that one. Once that one is paid off, you roll the entire amount you were paying to the next lowest balance and attack that. You rinse and repeat until all of that debt is paid off. And then very, very, very important, do not get into debt again. If you can at all avoid it, do not. I did that and I pulled myself out of it again, but I've been through it. So that's why that's highlighted in bold, all caps. One credit card hack that I'll share with you that helped me to get out of debt. It took a while for me to get to that point. However, what I did was I recorded credit card charges as if they were debit card charges. And so basically, I would, as I was reconciling my checking account, yes, you should absolutely be reconciling your checking account. I know a lot of people don't. I didn't for a while. Bad habit. You need to be reconciling your checking account. But anyway, I would use the credit card, record whatever I charged as if it were coming out of my checking account at that time. That helped me to slow down on the swiping because I could see, okay, I only have X number of dollars left before I get paid again. That will really help to discipline you as far as using your credit cards, and it'll help you to get out of debt faster. And then once you get to that point, if you have rewards cards, you can apply rewards to your statement balance, another way to reduce that debt. And now for the big R, retirement and planning for a more financially secure retirement. So first question you need to ask, how are you going to finance your retirement? So we have savings, which would be any account where you would kind of stash cash. So your checking savings, CDs, IRA accounts, etc. Also your pension or your Social Security if you qualify for both. And then supplemental accounts. So as school employees, school district employees, you may have access to 403Bs and 457Bs, which we'll talk about a little bit. And then also stocks, bonds, mutual funds, ETFs, things of that nature that you may sign up for brokerage accounts and trade on your own once you get comfortable doing stuff like that. After you research, you're comfortable making those kinds of trades on your own, go for it. If you're more comfortable working with a financial advisor who is licensed, who can help you work through that process, go for that as well. Entirely up to you and how you are going to fund and finance your retirement. This graphic, I absolutely love this graphic. I share this graphic every year during our new teacher academy that we have at my school district to encourage our new teachers to begin saving for their retirement. And we have new teacher academy for our brand new teachers who are fresh out of college and new to the district. So wide range, either seasoned or brand new. But this graphic says it all. So basically this illustration provided to us by the Vanguard Group, illustration of two people, one who began saving at age 25 and stopped at age 40. The other began saving at age 35 and stopped at age 65. There are the account balances for both of them at age 65. So the first person only saved for 15 years and then who knows what they did with their money. But when they got to retirement at 65, their account had over $1 million in it. Person number two began saving at age 35 and saved for 30 years until they reached 65. That account balance is over $220,000 less than the other person who began saving at age 25. That is what you call the time value of money. It's compound interest. It's all of that. So person number one saved less out of pocket. They saved half out of pocket compared to person number two. They saved for half the amount of time, and yet their retirement account is over $220,000 more. So that's why I said at the very beginning of this, I wish I knew this stuff 20 years ago, and I wish I had taken it to heart because I definitely would have responded differently. It's never too late, but The sooner, when is the right time to begin saving for retirement? The minute you think about it. When is the right time to start saving, period? The minute you think about it. A lot of information on this slide: 403B versus 457B, two different retirement vehicles available to school district employees. Your district may have one or both of these available to you, or they may have none available. But 457B, in my opinion, I love the 457B because, as you can see there in the comparisons between the two, it's a great penalty-free option for early retirees. So you can pull your money out of that account as soon as you separate employment. So if you have someone who retires early, they need to bridge until they get to be able to draw that pension. So if you retire at 50, chances are you can't draw your pension at 50. Okay. You might be able to draw it at 55. You need a bridge to get you through age 50 to 55. 457B would be a great option if you had money set aside there. Both of these accounts are going to allow you to save money pre-tax, so it's going to reduce your taxable income now. You pay tax on it when you retire and pull that money out. So this is just a great comparison, in my opinion, so you can look side by side at these vehicles and see if you want to put money into one or both, if you have the option to do that, as well as to just teach yourself a little bit more about funding your retirement, supplemental funding of your retirement outside of your pension and Social Security. And then here again, going back to, I'm not a licensed financial planner. I'm not a certified financial coach, but I wanted to provide just a brief definition on some of these other ways to supplement your retirement, supplement your income, and kind of explain what they are. So very high level definitions here. Individual retirement accounts, or IRAs, is usually what people will call them. They're available everywhere, from banks to credit unions to investment brokerages. The IRA is the investment vehicle. So what do I mean by that? It's an account that holds the money, but you have to direct it where to go. So placing the funds in an IRA and not directing those funds where to go is just like placing the funds into a savings account. It's not going to do anything for you. Money will just sit there. With IRAs, you can be as aggressive or as risk averse as you want. And keep in mind, with all investing, there is some level of risk. So that's the main reason you want to do as much research as possible, and either hire someone to help you do this, or really spend some time learning the language of investing and everything about investing before you start throwing money at investment vehicles. Stock ownership is about owning a piece of this pie, so to speak. If you own shares of stock in a company, you are a shareholder. And things have changed over the years with some brokerages. In the past, if you wanted to own shares of stock, you had to buy a full share of stock. Now you can buy just a small piece of stock. So if you don't have $3,000 or over $3,000 to buy a share of Amazon, that's fine. If you have $100 to invest, you can invest that in Amazon. ETF funds are basically bundles of different companies. So they are exchange traded funds. They're traded on the stock exchange like regular shares of stock. And mutual funds are companies that pool money from multiple investors and invest that money in stocks, bonds, securities, and other assets. And those combined assets make up a portfolio. So again, very high level definitions meant to give you an idea of what each is and which you may want to look into further to get on the path to wealth building, financial security, and more comfortable retirement. And we've reached the end of the webinar. It's my hope that each participant will apply these 3 key takeaways to what has been presented. So, number 1, I encourage you to learn as much as you can about finance. You don't have to become an expert, but I encourage you to learn enough to know the right questions to ask and the right direction to go. I encourage you to take what you have learned and put it into a plan, because things happen. Once you put things on a plan, that's the first step, but then you need to take action. So finally, execute that plan. A plan is useless unless action is taken. So I hope that these 3 key takeaways will apply to all of the participants in this webinar and those who are tuning in to the recording at a later date. And thank you so much for joining me today. If you're watching the replay on YouTube, thank you as well. For those participants who are registered, there will be a special gift opportunity coming your way in the near future. You will be receiving a code to download an upcoming book that I am publishing. It will be an upcoming ebook. It will be my first publication, so I am so excited, and you will be getting a code for that just for registering for this webinar. Again, big thank you to Dr. Desiree Alexander for this opportunity. Thank you all for joining me so much. That's all I have for today.
Thank you so much. I'm definitely going to share the email addresses to you for everyone who registered so they can get that code, because I'm sure they're going to be very upset with me if they do not get it. So I'm going to share the registration emails with you. But thank you so much. This information is invaluable. Like, everyone, if you're here, you wanted something, brought you here, right? You wanted to either know, am I doing the correct stuff, or you want to get better. So take this to heart and get started. And if you get confused, go look for another resource, right? Like, don't get discouraged. Go look for a video. Go sit down with people. And that's what I meant by, if you're in a school district and you are like, I don't understand all these health benefits, go sit down with that like, that is part of their job, is to sit with you and say, let me explain this stuff to you. So just, no one's going to fight for you the way you're going to fight for you. So start learning this stuff. Tamara, this was really awesome because, like you said, you spoke to us in verbiage that we can understand, and we appreciate that. And we also appreciate you volunteering and taking your time to give us this information.
Thank you so much. I am appreciative of everyone who is on this webinar right now, and I am very thankful to be able to share the information with you all. And thank you again, Dr. Alexander, for this wonderful platform. Thank you so much.